Hey guys, Toby Mathis here, and today we're going to talk about investing for beginners. If you want to have a retirement where you can actually enjoy it and you're not stressed about money, then this is a video you actually want to watch. And we're going to start all the way at like the 10,000 foot view of what is blocking people from utilizing something that's going to be painfully simple and that anybody could implement. Let's explore that for a second. Because I remember my daughter when she saw a black lab, it was a puppy, and it came running towards her, and she freaked out. She turned around, started to cry. It was when she was a little girl. And the dog was just a happy little puppy, but she was unsure of it. She didn't have knowledge of that dog, and therefore she immediately went into this fight or flight mode where she chose the flight, the flight. Most of us would when we're little kids, and it's a big dog. But the reason I bring that up is because for a lot of people, the stock market is that big dog, and it's just a puppy, and it's something that can give you a lot of joy and happiness, right? And that if you treat it right, it's just going to be a great companion. But for whatever reason, we're afraid of it. And so I want you to just realize that a little bit of knowledge goes a long ways to breaking through that fear. And so I'm going to give you a free site first off, infinityinvesting.com, or you can go get free training, and I'll talk about it at the end as well. Been working on that for years. I'm a tax attorney, 27 years. And all I know is that there's people that are very, very successful, and this is what they do repeatedly over and over again. And it's something anybody can do. In fact, there was a beautiful study done, I think it was Steve Hogan. They interviewed a whole bunch of millionaires, and the three top groups for making millionaires in the United States, it was not through inheritance, guys. It's actually people building it up. And it was accountants, engineers, and get this, teachers. And the reason being is because all three of those understood the idea of following a plan, consistent investing, and not messing with it, letting it bake like a cake. And so we'll talk about those. So let's dive in. First thing we want to do is do away with some of the fear and actually get into reality here. So imagine that you were investing back in 1980. And I'll tell you, this is exactly what happened. You just follow the charts with me. So you started right here in 1980 and you invested for years. And then in 1987, something happened. They call it Black Monday crash, where the Dow lost, I think it was 22% of its value in one day. Just big boom. And it was, skies falling, the stocks plunge, everybody's freaking out, it goes mad. And of course, everybody's showing all the pictures of all the traders as they're just absolutely losing their minds. Here's the thing. Everybody at that time is saying, get out of the market. You had a good run. It's too risky. You're going to lose your butt. There's no, like, you should absolutely liquidate. Sound familiar? Those are the people reacting out of fear. But if you didn't listen to them, here's this little 1987 hiccup, and you would have had this big run. And then something similar happened. This was in 2000, 2002. We had the dot-com bubble burst, right? Where they had all these pets.com, all this fun stuff. And then in one day, or in that 2 year period, you had this big rundown where everybody was like, it's over. The stock market is dead. Put a fork in it. You should liquidate all your holdings. Yeah, here we go. .com turned into .bomb, and all these crazy companies. See if you recognize Elon there. Who is crazy enough to invest in these things? There's Pets.com. Oh, why would anybody do this? You're crazy. Get out of the market. Go back to put it in your savings. Buy some CDs. Whatever. Everybody has great advice. Just quit. Get out of the market. You're going to lose your butt if you stay in the market. What are you thinking being in the market? And of course, you would have missed out on this huge run up. Here's our little downturn. Here's our run up. And when you look at this again, it's not even close. This is the S&P, this is the Dow Jones Industrial Average. This is just the historic numbers of this exchange over a period of time. This is 1980, and I think we're going right into 2008. So we're just cruising along. What happened in 2008? Well, if you guys went through it, we had this huge crisis. We had this meltdown. We had the Great Recession, whatever you want to call it, and the market just tanked. I think it was 38%. And again, everybody's like, oh my God, the Dow's dropping. You should get out of the markets. It's, Lehman's out of business. AIG's on life support. Everybody's losing their homes. You need to get out of the market. It's crazy. You're going to lose your butt. What are you doing? And everybody's, again, giving all this great advice. And then you would have missed out on this huge run up right after. And now we're talking about, again, huge run up from this stretch. And then what happens? Oh, yeah, we have 2020. We have this pandemic. And what does the market do? You think the market panics? Of course it does. And it drops again. And you hear the same thing. What are you doing in the market? You should get out. The market's crashing. It's down 12%. Oh my gosh, what are you, crazy? Your family's like ready to do an intervention, get you out of the stock market. What are you doing? You're crazy. And you would have missed out on this again. Just another huge run up. In fact, putting it to numbers, if you had invested $1,000 in the very beginning and just left it there, that $1,000 would be worth about $45,000 today. Compare and contrast that to what the US dollar has done. It's down 75 cents. So if you had done what everybody was saying, oh, you shouldn't be in the market's too risky, you should just put it in, just put it in your savings, put it in your account, that $1,000 would be worth right around $250 versus $45,000. That's why they say cash is trash. You're going to hear people always coming back. No, you should move to cash. You should move to cash. No, inflation destroys the value of that dollar. It's not a long-term objective. You might have some dry powder to take advantage of opportunities, but you need to be combating inflation because it'll literally devalue your money. It's like having ice. It just melts. And so if you don't want to have a big pile of water, you better make sure that your ice is in a freezer and that you're growing it. Now, I bring these things up because I want to deal with that fear. Statistically, over time, the market, if you just look at the S&P, it's over 10% for its life. Quite literally, year after year. Now, is it a straight line? No. It goes bzz, 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 bzz. That's why you just have to I'm going to advocate something called set it and forget it. But you need to consistently be investing, or you need to not panic when you see these pullbacks. Now, there's professionals out there that'll be like, oh, the pullback's a great opportunity. There's all sorts of great opportunities, right? But unless you have an expertise, sometimes it's impossible to know when something is an opportunity versus when it's going to just, cause you a boomerang effect and mess you up. Realistically, unless you are going to follow those markets on a daily basis and it's going to be something that's around your profession, it's going to be really, really difficult. So there's something called timing the market. Study after study. In fact, Schwab did one when there were 76 20-year stretches. Timing the market's almost impossibility. What those studies showed over and over again is that it's not about timing, it's about time in. It's about time in the market, not timing the market. Even if you were the best stock picker, or you picked the market when it was at its very bottom every time when you invested, you were slightly better than someone who just consistently invested the whole time. Slightly. And it's not even worth it. And it's almost impossible to do. So if you just consistently put your money into something that, and I'll go over some options for you, consistently over a long period of time, you're going to get great results. In fact, I like to look at numbers. Let's just say that we put $1,000 in a savings, and all we did is put $1,000 into something, into like SPY or VOO or any of the big indexes where we're just betting on the market. If all we did is just sat it in there, we'd be looking at about $72,000. Let's just say you did that when you were 20, and then you're going to retire at 65. So the total amount of time in that market was 45 years. You just sat it there. You did one investment of $1,000 and then you just forgot about it. I literally just set it and forget it. You lose your password for 45 years. You come back, there's $72,000 in that account. That's the value of the account. Some of it's going to be dividends, and you can just put them into reinvestment. Now, if you're wondering, well, wait a second, um, I don't know, $1,000 is too much. Okay. I use an analogy, and a lot of folks use the same one, which is, what about us? Like, people go to Starbucks every day. What is it, about $5? Let's just say that you did $5 a day times 365. So all you did was, instead of going to Starbucks, you just put that money instead into an account automatically, $5 a day, just automatic, boom, 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 boom. That's about $1,800 a year, 1825. What does that look like if that's all I did? If all you did was invested that 1825 over that same 45-year horizon, or just added that in as well, you would have $1.3 million when you retire. That's, again, if you start right around 20 years and you're going to retire around 65 years. If you're 30, then you're going to have a little bit longer time to let it cook. You might not be able to retire at 65, but the idea is to get in there early. Now, if you're older and you're saying, oh, shoot, then it's not for me. No, you just have to increase the amounts. It's so much easier. This is so much easier if we let it cook. So you get your kids in, do a custodial account if they're not 18 yet, if they're too young, and just try to get these, just try to max out. If you can max out like an IRA or something, you're even better. Get it into a Roth where they'll never even pay tax on it. That's even better. But if you just consistently put, that's not a ton of money. That's less than $2,000 a year. What if we bumped it to $3,000 a year? Look at the number then. We're at $2.1 million. In other words, just investing a tiny, like, even this is just a percentage of your income. Hey, I'm making $30,000 a year. Like, doesn't sound like a ton. And 10% I'm just putting aside. Or if you're making 60, put 5%. Like, just consistently, I'm putting money aside on a monthly basis. This would be at 3,000. That is $250. Excuse me, $250 a month. Do that backwards. $250 a month. So $3,000 a year. And what does that get you? A really good size nest egg when it's time to retire. What if we look at this a little different? What if we bump that up to $5,000 per year? If that's all you did, that's not even the max that you could put into like an IRA. If all I did is there and did that over that 45-year stretch at the average S&P, we're not even doing anything special on this, we would have almost $3.6 million sitting there just by consistently investing a small amount over a long period of time. Do you think you can do that? Because if you can, that'll give you the next steps. Anybody could do this pretty much, right? There's folks that are really struggling and they're barely cutting it. Look at things that they could cut back on. But if you're somebody making over $50,000, $60,000 a year, the only reason you're not doing this is because you don't want to, or you're unaware. And it's very easy to make a quick shift and put that type of money aside on an annual basis and get yourself to where you're going to be able to have a very nice retirement. So step one, I'm just going to say step one is know your numbers. Facts don't care about our feelings, right? And factually based, if we look at the history of the markets, if we look at their amounts that they continuously pay, and we look at those consistently, it's going to give you a ease in knowing that you're going down the right path. There's an old adage that says, he who understands compound interest earns it, while he who does not pays it. So if you understand the idea of compounding and allowing something to stay in the market and continue to grow, then you will end up being very wealthy. And that does not matter what profession you're in. Again, in the top three was teachers. Some of the least, like, these are not great paid people. In the top three categories for millionaires, there they were, sitting there. Why? Because they teach, but they also consistently put monies into their 401ks and their retirements. And they work that profession. They do 35 years, 40 years, and they come out and they have these big nest eggs and they continue to grow. That's the thing, is just because you retired doesn't mean you turned it off. It means that, let's say you became a teacher when you were 30. we're talking about when you're talking about 50, 55 years when you get into your 80s, not 45. Like that thing's even compounded more. You've started to draw and take some of it, but it's continuing to grow. It's not like it just goes away. Step number 2, and this is the one that trips some of you guys up, right? It's this fear. Open an account. And when you open an account, I'm talking about a brokerage account. So you're going to use like a Robinhood. You're going to use, like, that's a super easy one. You could go to Fidelity. You could go to Schwab, TD, Ameritrade. You could go to E-Trade, Webull. Like there's a ton of them, right? You just pick one. M1, that's another one you could use. All of these, a lot of these are like you can just do it on an app. Like Robinhood, I remember when I opened my first account there, I was like, oh, let's see how long it takes. Took no time at all, but I think it was probably about 30 minutes total time of my time. I think they had 2 days to prove something, but then all of a sudden you're able just to start investing. And again, if you're wondering, how do I invest? I'm just going to say the easiest thing to do is to automate it into an ETF. That's like a big bucket of stocks. There's SPY, there's VOO. There's even something called Devo. That's Kevin Simpson that does covered calls inside of an ETF. It's done fantastic since it was inception. But these are ETFs. This is just automate into an ETF. If you want to learn how to do this, go to infinityinvesting.com. And again, free account, free basic account will teach you how to do this. If you need help, there's a small fee on a monthly basis to have access to a basic room where you can come in there and there's professionals that will actually show you how to trade. So if you're scared to do your first trade, just come in and check us out and we'll help you. But you're going to automate 2 things: your funding and your investing. You want to make sure that your account gets money in it. So if you're going to put, $250 a month into an account, or if you're going to put $5 a day into an account, it should just automatically move over. In other words, get it out of your checking. You don't want to see it. You want it to be automatic. Hey, every week it withdraws, or every month you pay it like a bill. Let's just say you treated it like it's your cell bill. Hey, I'm going to pay $250 into my brokerage account, or 150 or 50 or whatever you can afford, but you consistently put it, and then you make sure that the account automatically invests that in an ETF or into certain stocks, depending on your risk. Like there's a risk reward here. If you're somebody who feels confident in your investing and you've done some training, pick some individual stocks. If you're somebody who doesn't know this and you're just like, hey, you know what, I just want to be exposed to the market, then do SPY or VOO. You will not be disappointed. It works like crazy. And then step number 4, it's just like baking bread. You gotta let it rise. And so you wait. Be patient. Just allow it to continue to grow. But if you go in there and you yank the money out early, then you're not getting the rise. It's just like bread. It'll just fall. Be like, oh man, I didn't get the benefit of all that compounding. So you got to be patient. And then step 5, if you do this over a long enough horizon, you are a millionaire. Go to infinityinvesting.com and learn more. We'll teach you how to do this. Anybody can do it. Anybody can do it, including you. And the only reason you're not is probably because you didn't know this information. If you can, and you know anybody that would benefit, share it out. We're on a mission. We're trying to help people make more money. I'm a tax attorney. I need people with tax problems, which means they need to make a lot of money. So we're going to do everything we can to help people make a good amount of money so they can have a great retirement, and that they're not subject to this paralyzing fear that's out there and this this constant doomsday. Just remember my original examples of people all screaming whenever the market corrected, it's time to bail, it's time to bail. And you would have missed all that opportunity if you listened to them. So listen to the people that have been there, done that, got that t-shirt, and have had the success, and ignore everybody else.